If you listen to the consensus right now, 2026 is shaping up to be a perfect year. The banks are bullish, the Fed is cutting rates, and the AI train supposedly has no brakes. It feels safe. Everything's just coasting along. But in investing, the safe consensus is often the most dangerous place to be. Today, I'm challenging the positive growth outlook making the rounds. My counter argument? We don't have much confidence at all about what the market will do next. And whoever tells you otherwise probably doesn't know what they're talking about. We need to look at what the data actually says about expert forecasts, the lazy dismissal of contrarian signals, and talk a little bit about our current market structure, which looks terrifyingly similar to 1999. First, a quick disclaimer. I am not yet a financial advisor, and this is not financial advice. I am just a guy on the internet pointing out that bigwig Wall Street strategists fail in their predictions more often than a coin toss, and giving you common sense reasons not to listen to their noise and nonsense. The content in this video is for educational and entertainment purposes only. Past performance, including for the S&P 500, is not indicative of future results. Investing always involves risks, and do your own research. It's important. I've seen the tables circulating from the major institutions. Morgan Stanley sees double-digit upside to the S&P 500, for instance. BlackRock is all in on the AI investment boom. So is Deutsche Bank. The general vibe is that if we do get a pullback, it'll just be a little air pocket. Nothing to worry about. Markets will snap right back. Nothing to see. This is comfortable. It tells you to keep doing exactly what you're doing right now. Trading those high beta individual tech stocks and trying to get rich off of Nvidia. But before we bet our boring, diversified portfolios on this and just start trading individual stocks or loading up on tech sector stuff, we need to ask a really basic question. How good are these institutions and strategists at actually predicting the future? What does the track record say? The answer is not very good. Comprehensive studies tracking Wall Street strategists over nearly 2 decades now have found that their ability to predict the market's direction is roughly 47 to 48%. To put that in perspective, that's statistically worse than a random coin toss. If you flipped a coin to decide your portfolio allocation for the upcoming year, you might actually have a better hit rate than the smart money consensus. This is backed up by multiple studies. I've included just one of them on this slide. History proves the unreliability of market forecasts time and again. In January 2008, heading into the global financial crisis, the consensus forecast wasn't a crash. It was a soft landing with a projected positive return of roughly 11%. In reality, the market fell 38%. Conversely, entering 2023, the consensus was overwhelmingly bearish, predicting a recession. Instead, the S&P 500 ripped over 24% higher. So these targets that people are tossing out aren't crystal balls. Strategists are simply projecting today's weather into tomorrow's forecast. And if you look at that chart, you'll see that most years are not average for the S&P 500. So when you see people tossing around projections like 5%, 10%, 11%, even 15%, they're just trying to land in an average so that they can point back and say, hey, we predicted what the S&P 500 does on average, but if you look there, the S&P 500 almost never performs its average in any given year. It's either extremely up or extremely down, so keep that in mind. Finally, let's address the claim that AI isn't the dot-com bubble. I don't know if it is. I don't know if it's not. Neither do you, neither does Wall Street. In some ways, though, concentration risk is more extreme. In 2000, at the height of the tech bubble, the top 10 stocks of the S&P 500 comprised about 26% of the index. Today, the Magnificent Seven make up nearly 37% of the index. We have historically high concentration risk, and our valuations right now we're looking at forward price to earning multiples around 22 to 23 times earnings. This is dangerously close to the 25 times earnings multiples we saw in the late 1999 situation. And when the market is priced for perfection, as some people say, you don't really need a perfect storm to cause a crash. You just need a tiny disappointment to start the fire. In 2000, the air pocket people predicted turned into a 78% decline for the NASDAQ. You don't know how deep an air pocket is until you're falling through it. So be careful. The positive growth outlook for 2026 feels safe right now because it confirms what we want to believe. But if you are betting your financial future on a consensus that fails a little more than half the time, while ignoring historic valuation risks, you aren't investing, you're gambling. So be skeptical, look for value where others aren't, and don't blindly follow the herd. And if you don't know what you're doing, well, just stick to what's safe and what's good. I can't give financial advice, but I can say that a boring fixed index portfolio has worked well for me and well for a lot of other people. You're watching Miller Momentum, and I encourage you to like and subscribe for more reality checks and other great stuff on my channel about my own personal investing strategy, as well as the Boglehead approach. Salutations, and I'll catch you next time.